computer models. And so that was interesting for a while also, but at a certain point I decided I wanted to be a professor. Turns out you need this PhD thing. So I sort of left that and went off to do my PhD. I did my PhD in electrical engineering, but I wasn't like a circuits guy, or I couldn't sort of build anything useful or anything like that. I was basically an applied mathematician. So I was where Guillermo was at, which is the Information Systems Lab at Stanford, and the kind of stuff I did was with things like decentralized optimization and consensus algorithms and reinforcement learning and sort of things like that. And so
wait, who was your advisor?
Ben Van Roy.
Oh, yeah. Okay, that makes sense actually. He's doing weird reinforcement learning theory stuff now, actually, which it's very cool. He almost poached me, but I think Steven took the cake on that one.
So he's, I think he's become very focused in recent years. To his credit, I think that's sort of a great way to proceed. I think he's exclusively doing reinforcement learning, but he's been interested in a broad range of stuff. Like he's written microstructure papers, and
interesting.
and so on. So kind of from there, I faced a career choice, and I think the thing people don't realize about business schools is there's a subsection of business schools, in particular the type of group I'm in, which is sort of like an operations research group, where people are basically applied mathematicians. So you could do much of the same stuff that I was doing in engineering. The math is very similar. It's just the applications are different, right? So the applications of what I did in electrical engineering would be stuff like maybe controlling a network, or controlling a robot or something like that. Versus, in a business context, people think about like, I don't know, quantitative trading, or how to get people to click on ads, or, how to set up assortments in online retail or stuff like that. But the underlying math is really quite similar. And, just sort of speaking as a little bit like as an academic structurally, there are some advantages. The biggest advantage by far being that at the time, and I think still even through now, business schools are growing. So it's just sort of much more attractive job market as an academic. The salaries are higher. The job is a little bit different. The funding model is basically driven by MBA tuition. And so the teaching is a little bit more emphasized. But the flip side is you don't really need to write grants. Versus if you're an engineering professor, you have to, that's a big part of your job ends up being writing grants to, pay for your students, and, if you have labs or anything like that. And, maybe the best thing of all, at least for Columbia, is it's in New York City. And, I'd always wanted to come back to New York City. So I ended up back at Columbia. I kind of switched my research in the sense that the applications I think about, I decided to go back to finance. Because, I had some background in there, and I thought there was sort of interesting mathematical problems. So, the main things I've worked on are, on the one hand, methodology stuff related, to things like stochastic control and approximate dynamic programming. But, just sort of broadly, how do you make decisions sequentially over time when there's a lot of uncertainty? And then the main applications I think about are related to things like market microstructure and quantitative trading, and now hopefully some blockchain and in DeFi type stuff.
Yeah, so you definitely kind of got to that point, but what first kind of attracted you to problems of the intersection of cryptocurrency and economics? You have a unique background where you worked a bunch in a bunch of different industries and then ended up here. I guess I had a similar path, except I cut out the PhD and kind of just went from working in bio-related stuff to this. But,
which we're all shocked about, by the way.
Yep.
How that happened. But
yeah.
Is it your whole family too?
I definitely am like the slacker in my family. Everyone else has a PhD, and they all make fun of me. So it's kind of an unfortunate scenario. But, how did you end up kind of being interested in crypto? Was it like the electrical engineering background that really, and the kind of working on consensus stuff that really got you, or
So I knew about it for a long time. Like I think like in the 90s, I used to be on like the cypherpunks mailing list. And I remember like DigiCash, like the Chaum guy and so on. And so these are very, very old projects. I heard of Bitcoin, but it didn't really register. It struck me as sort of a big sort of crypto thing. And I think that's a fine area, but I'm not a cryptographer. So I didn't think it seemed like an interesting technology, but outside of my scope. But the way I got into it as an academic area is my co-authors on the transaction fee work, which are Gur Huberman and Jacob Leschno. They sort of came to me and they explained to me how Bitcoin actually works. And I realized under the hood, there's a queuing network. Right, which basically, the idea of you have the mempool, which all these people are waiting for their transactions to be processed, and any rational miner will in Bitcoin will sort those transactions by the transaction fees that they offer. That is quite literally like a priority queuing system. Right. And then immediately, like, sort of light bulbs went off, which is, hey, maybe, tools like, stochastic analysis and sort of the type of theory that I'm familiar with might apply there. And maybe it's the underlying questions are not just questions about cryptography, but are maybe operation style questions, also maybe economic kind of questions. And, that's the direction I'm interested in.
So, I mean, this might be like a little forward-looking, but I guess here's a big question: is like, what do you think are, like you mentioned a few number of tools, such as. Also, sorry, I have a dog licking me right now, so I will apologize for randomly breaking off. So you mentioned there are some interesting tools that you can apply to that come from in our case, for example, control theory and things like that. And what do you think? I mean, are tools that are kind of undervalued, so to speak, in crypto? I mean, obviously there's a bunch of papers that we can write, and we are writing one, for example. But what kind of analysis do you think applies very well to crypto that you are particularly well suited for? I have my own answer to this because we're weirdly similar in our things, but I'm just curious about yours.
Yeah, I mean, I think just general, sort of probability and stochastic analysis, in my mind, seems a little bit undervalued. I think there's a lot of people. Maybe the vast bulk of at least the academic stuff is really on either like sort of the crypto side or like, Byzantine fault tolerance or like the consensus side, like all kind of that stuff. And then I think at the other end, there's sort of people looking at it through very kind of high level economic models. But I think sort of understanding stochastics. Like, I mean, let's just focus on DeFi for a second. I mean, I think a lot of the, sort of tools that we have in traditional finance, things like stochastic calculus and, options pricing theory and, sort of applying those ideas in this kind of context. I mean, you guys have done some of that work, but I think those tools aren't broadly applied. And so, for example, before I was talking about, let's take a product like mortgage-backed securities. I mean, there's a huge industry of models built around stochastic analysis and Ito processes and whatever that lets you price these things and hedge them and so on. And, there's just really a lot of modeling tools. Now, one might argue that maybe a lot of those models are garbage and, maybe they failed in, great financial crisis and so on and so forth. But there's a whole industry of models that tell you how to price these things and how to hedge them and so on. I don't see that in sort of the DeFi world. So I think to the extent that those tools seem useful to me, I think figuring out what the right methodologies there to sort of port over is quite interesting.
Yeah, no, for sure. I completely agree with your general statements because it's kind of this weird, funny in between where they're the two camps that have become initially interested in this for many reasons are use very different tools, and I think well adapted things like economists already know on it. So, anyways, also totally random, and we're gonna switch slightly on this, but we alluded to this right before people got here, and we still want to know the answer to this, which is, you have a trading firm or, as you call it, extracurricular activities, named after a number of French mathematicians who are pseudonymous. First things first, can you explain who Bourbaki is and then how did you come up with like that's such a phenomenal name for a trading firm?
All right, so our firm is called Bourbaki LLC. We're a small quantitative trading firm, basically trading equities using systematic strategies. So our namesake is Nicholas Bourbaki, who was, my understanding is, around the 50s, an author of a whole bunch of math texts in France. However, it turns out it wasn't one guy. It was sort of this anonymous collective, and they sort of had this. I'm not sure sort of fully what the philosophy was, but they were certainly very secretive. And maybe the philosophy was that like no one should get credit because math is universal or something like that. I don't know. I shouldn't speculate. But they were secretive and they knew a lot of math. And so I thought it was a great name for a quantitative fund. Now, it wasn't actually me that came up with it. My cousin, who is a lawyer, at the time we were starting, I was sort of telling him kind of what we were going to do or something, and he's like, "Oh, you should name it Bourbaki." And I was like, "That nails it." And just as we were sort of talking about before, it's actually quite hard to come up with a good name for a hedge fund because all the good ones are kind of taken and sound generic and so on. So I think this one is like a sort of pretty obscure. But for people who know math, it's sort of immediately recognizable.
It's so good. It's so good. Yeah. It's so good.
Yeah. So as far as, you're trading now, it sounds like, what you mentioned, you're doing systematic trading on equities. So in the 90s, you were doing discretionary trading on more complex instruments like interest rate derivatives. Sounds like maybe relative value.
That's right.
Maybe buying some volatility like things. So the instruments were maybe more complicated back then, but the strategies were discretionary. Now it sounds like equities, the instruments are simpler, but issue from LDCM maybe driving that. But anyway, how's trading? First of all, the trading industry evolved, since you took a long break from it and are now back? And how has your personal view on trading changed?
So I think the type of stuff I do is quite different. I think it is way more sort of numbers driven. Like you do back tests and you compute Sharpe ratios and this and that. Everything is basically data driven. There's very little kind of discretion. I think that's sort of quite different. I think a second thing that's different is, as I was kind of mentioning, the type of stuff we were doing before was kind of leveraged. And I think another flavor of it was basically like in relative value trading, you buy something that's cheap and you sell something that's expensive. And maybe also you earn money on the way. Like it's, these trades are typically positive carry. But in a way, like you're getting paid for typically owning something that's illiquid. Right, so there's you hold these things that are very illiquid, and you may end up in positions where it might take like you own some weird bond from some weird country, and whatever, and it has these weird characteristics. It might take a weeks to sort of get out of that. So I think the other thing that's quite different is, we trade like liquid equities. Like if we wanted to turn off our trading, we could be to cash tomorrow. Like it's so I think that sort of gives me a lot of comfort as well. I know we're not taking sort of crazy liquidity risks. And I know everything is data driven. Now, I think the thing that's a little bit reminiscent of that time that in some ways gives me pause is that it's a very competitive business. I'm obviously not the only one out there doing that. And so I worry sometimes that the space is sort of too crowded and you may, I think it's you constantly have to develop new stuff, but also things get crowded, and I think when things get crowded, you see very weird, anomalous kind of market behavior, and I think there have been a number of instances in that of that over the past few years, and when that kind of stuff happens,
everything. Question. Yeah. What are some examples of that type of stuff? Do you mean like Ronin blowing up in March, or do you mean like clearing firms and stuff are centralized sort of failure points for smaller quant funds, or do you
So
what are some of the examples?
The biggest example of this is a little bit dated now, but is sort of the quant crash of what was it, 2007? It was 2007 or 2008, where basically I think this is public, but my understanding at least is there was one large quant fund. I think it was a fund run by Goldman Sachs Asset Management that kind of was doing some stuff that they were doing sort of like, let's say, quant equity stuff, but they were also doing stuff that had exposure to credit markets. And this was right before the great financial crisis. And so you start losing money on the credit market stuff. You start deleveraging everything. You start taking off your sort of quant positions, right? And if people's positions are all, if trades are crowded, if things are all correlated, then other people who are, let's say, pure quant traders who have no exposure to let's say mortgages or whatever, they're going to sort of start to lose money, and you're going to see prices move in ways that like you sort of never seen in the news. So I think that's the single biggest instance. But there are a handful of instances, like let's say in even in like around the time of coronavirus, that there are sort of extreme factor movements that like you sort of wouldn't expect given statistical models and stuff. So I feel like that kind of thing happens. Has been happening more often the past few years. I think when the another instance is maybe when the VIX blew up in what was this in 2019. So my memory is a little bit hazy here, but I feel like there's more and more kind of anomalous market instances. Now I think the thing that
you mean like Volmageddon, like February 2018.
February
when basically, but
you.
that was due to like a structuring mismatch, right? Because TVIX had a redemption policy that marked end of day, and everyone just bought up all the options on I was in HFT then, and I remember there was this mad dash of everyone at my work sitting and click trading, like buying up everything because they knew that the ETF basically had to buy a certain number of S&P options after the close. And basically, like every single person I knew in quant trading was like, shut the door, I'm on the computer click trading. Like everyone turned off the algorithms and just started just buying up in front of these ETFs because like they had no way to get out of it.
Because it's so predictable, right?
Yeah.
Well, I mean, I'm not a vol trader, so I wasn't as close to it as you were, but I think there was broader craziness after that. Right, like I mean, that seems like one sort of small corner of the market, one particular a volatility product, but then that thing blows up and the whole market becomes volatile. I think there's lots of linkages going on behind the scenes that are sort of hard to understand.
So what I never really understood, and maybe you two that have actually done systematic trading, as opposed to theorize about it, could tell me, but so there's all these idiosyncrasies in the market that arise from different types of practitioners entering and different levels of competition going on that models that maybe are not even understood by the people that are implementing them and so forth. As people talk about black boxes and so forth, and so there's all this weird stuff happening in the market. Sometimes there's weird stuff that you can turn into a systematic strategy and make money off of if there's some systematic mispricing that occurs as a result of that. But you are talking about quirkiness in the market that you can't take advantage of as a trader, that just is a risk that you don't really fully understand or don't know how to capitalize on.
I think I think the first part of what you said is true, but you have to remember that markets are pretty efficient at the end of the day, right? So the kind of signals you're predicting are very, very small. Like, just to sort of be concrete about it, like let's say you're doing a linear regression. Like when people do linear regressions in the social sciences, like does smoking cause cancer or whatever? Let's do a linear regression, right? They look for like R squared. They want it to be like 50% or something like that, meaning that you've identified a variable that explains 50% of the phenomena that you're trying to understand. In quantitative finance, I mean, you have R squareds that are well less than 1%. You may measure R squared in basis points, like 1/100%. So So you're in an environment that's very, very, very largely like sort of noise driven, and you're really relying on making many independent bets, whether those bets are spatially independent across assets or temporally independent across time. But you're relying on sort of independence to sort of drive that. And at any instance in time, suddenly things are not independent the way you thought they were, because you thought like I don't know, maybe you have a just to sort of make something up, maybe you have a momentum signal, right? And you thought you're making these independent momentum bets on 500 different stocks, but it turns out there's someone else making momentum bets too, and he's been forced to deleverage, and so all of a sudden all those bets turn out not to be independent, and they all simultaneously go against you. So that's the type of thing that can happen. Now, I'm not saying that's what happened in Moallemi and so on, but that's the type of phenomena that worries me, because it's the type of thing that's very hard to predict, because at the end of the day, in this type of quantitative trading, it's all sort of data and historical driven, and now you're talking about emergent behavior that has sort of never happened.
So maybe that's a good place to jump off to DeFi. So I think one interesting fact about the TVIX and SVIXy kind of Volmageddon crash, well, outside of looking at my one colleague crying to my left and on the other side, I looked at this other one who was like, I made $20 million. And I was sitting in the middle being like, nothing changed for me. But one interesting thing about those is that the redemption process, the creation redemption arbitrage and the creation redemption conditions are actually not super transparent to people, right? You could go read the prospectus and try to figure out how it gets closed, but if you weren't also monitoring how like the market trading was working on S&P options in particular, right? Because you have to buy the whole strip of S&P options to replicate VIX. You wouldn't really actually have known this was going to happen, except for like this very, very small community of volatility speculators. In DeFi, however, the creation redemption process is extremely transparent. It's not only is the prospectus public, it's you see the code that is being executed, and you could go through and test directly against it. So do you think
that's in theory, though? I mean, yes, the code is out there, but at least in my very limited experience, there's so many like layers and so much to understand, and there might be other things linked to it because of common sets of investors, for example, that you don't know about, right? So I think it's more public in some level, but it's also incredibly complex.
For sure. I guess maybe the question is, if you kind of speculate like to the future, do you think that there's a world in which this ends up being a much better way to do sort of ETFs, vol products, and funds than the current system, or do you think it's sort of doomed sort of intrinsically?
Well, I think it's super interesting, and that's why I'm spending time thinking about it. In terms of, I haven't thought specifically of about how DeFi would represent, would replace something like a vol product or an ETF. I mean, I guess maybe some people might view sort of the automated market makers as somehow holding a portfolio and stuff. I mean, I think there's very interesting kind of technical challenges here, and that's what attracts me to it, in the sense that the whole world is sort of so different than traditional finance, right? You could start at the lowest level, and there's all the crypto stuff and zero knowledge proofs and whatever stuff I don't know anything about, right? But then you lift up a level, and there's the fact that things are done in blocks, right? So, for example, time is discrete. You have this shared universal state. Storage and computation are very expensive, right? So it's kind of a whole different universe, and in that universe, different stuff has emerged, and I think it's sort of quite fascinating. Now, is that stuff better or worse than the existing stuff? I don't know. If we take let's say how markets are done in traditional finance. It's not universally the case, but probably broadly, most liquid markets these days are electronically traded on limit order books, right? And I think limit order books have some nice properties in the sense that they're they're easy to explain and understand. They're sort of quite expressive and so on. But it's by no means clear that that's a good mechanism to exchange things. And I think the existence of high frequency traders is sort of the proof of that, right? So I think high frequency traders, I mean, I don't think they're parasites. They provide a service. They match people up over time, right? And they earn some economic profit for that, right? But the fact that you need them in order to intermediate between, like, let's say, a natural buyer and a natural seller who may just simply arrive at different moments in time highlights that that mechanism may have certain sort of problems. Now we go to the sort of DeFi space, and the analogous mechanism, again, to at least to my understanding, seems to be these automated market makers like Uniswap and so forth. I think those structures are very interesting, and it's interesting to analyze something that is transacting on the kind of scales that it is. But on the other hand, it's not clear to me that if I was designing a market from scratch, I would necessarily pick that. I think a lot of that type of structure is driven by the fact that storage and computation are very expensive, and it's because you're doing it in the context of a blockchain, right? If you didn't restrict yourself to that, if you're willing to, let's say, run it in a more of a centralized way, it's not clear to me that those same limitations, like that's the market structure that would emerge. So I guess it's kind of I think these things should be sort of studied to understand the properties. But I think we also have to be clear that I think, at least in my mind, they took that form because they had to operate in a certain kind of environment, which may be sort of quite unnatural in sort of a broader societal context. Like, I don't know, maybe this might be sort of unpopular here, but I think at some level, I'm quite amazed at decentralization in general. Like things like Bitcoin and Ethereum. Like, hats off to all those people. I mean, it's absolutely amazing that these systems work and they work at scale and so on. But in another way, I think there's a general kind of meta theorem where if you compare a centralized system and a decentralized system, it's typically much more expensive and complex to run the decentralized system, right? So if your focus is not necessarily, I want a decentralized system, and I want it to be censorship proof, or whatever the reason is you want a decentralized system. If your focus is, I want the best mechanism for people to exchange assets, it's not clear to me that you want to be operating under the kind of constraints we see today in the blockchains that exist.
I think a key question for me is what is actually centralized versus decentralized, right? So on a limit order book, right, the actual database of what limit orders are outstanding and so forth, who canceled what, is centralized. But there is a very much decentralized group of traders that is creating price formation and whatever microstructure mechanism exists such that the price actually makes sense, right? The game that's being set up by the person who stores a limit order book could be, the formation could happen from a very, very diverse group of people. Now, the automated market maker, in some sense, at least some aspects of it are actually more centralized, as opposed to if you think about how you implement a limit order book on chain, discrete peers need to come together and agree on trades versus, there could be an asynchronous relationship between the trader and another trader that came at a previous point and basically, in some sense, placed, continuous limit orders, across a large spectrum of trades, if that makes sense. Mm-hmm. So, in some sense, these AMMs are more centralized. It's just who gets to update the database is more decentralized, if that makes sense.
Right. No, yeah. So I think the specific aspect, you're right. The specific aspect of decentralization I was referring to is if you wanted to operate on a blockchain, as opposed to, let's say, someone's going to run it on their computer.
Right. So this is what I wonder sometimes is, as an actual retail trader, which is in many ways a good analogy for a lot of people that are contributing liquidity on current generation AMMs. no, actually some increasingly institutions, but for the most part, retail traders. If I place a bunch of liquidity in an AMM, we've done some work, and you can think of that as like me selling a bunch of people some options and so forth. You can think about it in different ways. I mean, that's in principle not very different to placing a limit order on the book, and then somebody basically takes that as a free option that they can trade against me. And unless I'm like very, very actively managing my positions, it's a lot easier to just place a limit order book and go to sleep. And if it gets billed. So I wonder, like, if that's just driven by the fact that current AMMs are just not really professionalized, versus what happens in a world where they're more actively managed by more professional market makers. So I don't know if that's maybe like a constraint of the current implementations, as opposed to a fundamental constraint. Maybe you have some thoughts on that.
So I think what you're pointing out is actually a great observation, and it's something that I think is quite interesting as well. In that in the DeFi space, AMMs are viewed as an investment instrument, right? Like you should invest in this AMM, you'll hold some basket of crypto, and you'll earn some fees. Okay, maybe you suffer some impermanent loss and so on, but nothing comes for free. But it's viewed as, like you say, like a retail investment product. I don't think anybody views a limit order book as a retail investment product. I think a limit order book is viewed as a way to transact. Right. So if you want to, buy an asset, you can leave market orders. You can leave, if you're a little bit more patient, you can leave limit orders or so on. But there's no kind of, long-term sort of fire and forget strategy in a limit order book. And I mean, there are people for which that is, but they're high frequency traders, and they're sort of constantly managing their positions, right? And a very, very kind of dynamic strategies, right? So something that is perhaps not accessible to the most common retail trader. So I think that's a huge difference. I do think again, I'm not familiar enough with the actual sort of real world trading and the data in the AMMs. Have been sort of more looking at them at a theoretical level. But I do think as the market becomes more professionalized, you'll see things like viewing AMM not as like sort of a static investment, but sort of a quickly moving in and out of supplying liquidity based on things like what your exposure is maybe across different AMMs, what your short-term forecasts are, sort of things like that. It'll start to look a little bit more like a sort of high-frequency trading in the limit order book, except instead of placing particular limit orders, you're either sort of participating in it or not. So I do think you'll start to see that. But I think it's sort of quite fascinating that this is really a retail investment product. And I think one of the most fascinating areas about it, and you guys have done a bunch of research, I think are really pioneering this, is understanding what are its characteristics as an investment product. Right. And, again, the analogy I was making before, like, if we're thinking about investing in mortgage-backed securities, there's a lot of models that, sort of give us perspective on, am I buying something that's well priced? What risks am I taking? So on and so forth. I think it's, really the next generation of work here is to sort of develop those kinds of models for these type of products like AMMs, which I think, are really unique and are something you do not. I think there's nothing analogous in the traditional finance world.
That's certainly one of the ways that we think about it very often is like that, because as a retail investment product, or even not even necessarily fully retail investment product, because again there are some more sophisticated investors that presumably are managing things a little bit more actively in terms of adding and removing liquidity. Maybe not to the extent that you envision in this end state that you described, but probably to some extent. Is that very often some of the strategies that they would implement on an order book would actually be very cumbersome for them to do. In other words, let's say you wanted to have an ETF of 3 assets, with variable weights and so forth, and continuously rebalance to them. That's actually kind of hard to do as a regular person, because you have to continuously be buying and selling different assets and doing so in ways and placing, your orders strategically on the book and so forth in order to rebalance it on an optimal rate and so forth. That's very difficult to do, or even more, more concrete way, if you're replicating some, or doing your old job and replicating some volatility exposure that you have or something. That's very, very difficult to do. But you could have you could implement a curve potentially easily that could rebalance the portfolio for you, and then have other people do that at some cost to you. And so that as a retail product likely stays. But the question of how people add and remove liquidity, or even adjust their liquidity across different types of curves, is a really interesting one. So one question I guess there is, so you trade obviously equity, you trade in a bunch of different markets. What do you think would be required, either from a theoretical perspective, a technological perspective, in order for people like yourself to be actually actively trading in crypto, either using AMMs or trading on them or supplying liquidity to them and so forth? Is it theoretical work that's missing? Is it technological innovations that are missing in order for that to happen? Or what is it?
I think the thing that would sort of concretely keep me from trading on an AMM right now is maybe higher level stuff, like just and again, this is my own lack of familiarity, issues around I think there's a lot of technology risk in terms of maybe smart contracts getting hacked. There's there's a lot of counterparty risk, like in terms of I guess once you're on the chain it's sort of fine, but maybe if you have to trade through five sort of weird dodgy exchanges to sort of get there or so on. I think there's a lot of complexity in that space that I don't understand. And also it's constantly changing. So I think that's sort of the concrete thing that keeps me from actually trading my own money there. But I think in addition to that, I think so. Okay, so I think one sort of concrete thing that's very important in the limit order book world that I think has gotten some attention but less attention in the AMM world is this concept of sort of adverse selection. Right, and I think if you're a high frequency trader, right, the number one thing that and you're making markets, let's say in equities, the number one thing you care about is adverse selection, which is just to be concrete, if you leave an order and someone trades against you, conditional on that trade, what's going to happen to the price? Because usually, someone you're leaving a bid, someone is crossing the market and paying half a spread versus mid market to trade against you. They may have some information, right? And so usually conditional on the trade, like let's say you just bought a bunch of stuff, probably the price is going to go down and you're going to ex post regret it, right? It's sort of the classic lemons problem in economics. So in high frequency trading and limit order books, that's the number one thing. The number one thing is sort of, observing the market, observing correlated assets, observing what's going on in the order book, sort of watching everything and making real-time conditional predictions on adverse selection. And when your expected adverse selection is going to exceed the spread you're going to earn, then you stop supplying liquidity, right? So I think incorporating that kind of analysis into these AMMs is, I think, the main theoretical thing that's missing, because a lot of the models that people have written down are basically assuming that the main people trading against you are arbitrageurs, right? And so arbitrageurs are basically only going to trade against the pool if the price is wrong, right? And so those are trades actually that maybe you don't want. Right. Whereas in reality, I'm going to guess that, and again, I say this without having looked at any data. I'm going to guess that there's a far bigger universe of traders, and there's potentially a lot of noise traders, and those people you're going to make money off of. And so I think you sort of have to model that. But I think so. So I think that's sort of one issue. But I think sort of beyond that, I think I'm beginning to understand this space and the DeFi space, and it's a very, very complicated space. And I think that's actually the main challenge is sort of understanding all that complexity, especially the sort of the technical complexity, not so much the mathematical or economic complexity, and sort of getting comfortable with it.
So I'm going to take a second here to show a picture. So this is that was kind of a weird alpha leak, right? Because I think, technically speaking, what we're writing all together, Ciamac, Alex, and I, is very related to this. But also, we've done a little bit of work on adverse selection and the connections between inverse selection and curvature, which is very similar to kind of the classical, order book literature for CFMMs. I think in some paper, what was the name? I think it's called When Does the Tail Wag the Dog or something like that. So, I mean, and we it's kind of weird because in some sense we've reconstructed a lot of, things that were known in the 80s for classical order book stuff. But it's a very, I don't want to call it naive because I think it's not quite the right definition of curvature that we have. But it's, in some sense it does most of the work. But yes, I agree. And in another sense, it's a very qualitative work rather than a quantitative one. It's potentially not as useful for active trading, and so I think it's a phenomenal research area to go into.
I didn't say nobody has thought about it. I said few have thought about it, and you guys are ahead of the curve.
Do you know that? Do you know the few understand meme of the summer?
I don't.
It was a very bad DeFi meme. So anytime anyone says few, it brings back memories of before kind of DeFi got really crazy.
Right.
But yeah, I agree with you, although I think it's starting to increase in sophistication. I think the real question to me is that, getting back to your complexity point, as someone who both works on analyzing these protocols and investment protocols, I have to say, there are at least 20 to 30 projects that are basically making structured protocols that are coming out in the next, call it 2 to 6 months. Mm-hmm. These protocols, I just don't see who the consumers are. They're basically 3 funds and firms right now in DeFi who probably can be the only people underwriting or creating structured products, right? 3 Arrows, Alameda, CMS, maybe a couple others. But one question I have is, when you think about the development of the equities markets, right, for these vol products to really get a lot of uptake, there needed to be kind of A, lingua franca, so something like a Black-Scholes, B, electronic markets, and then C, sort of some ability for teams to price these products. What do you see as the impediment, let's put it this way. What do you see as the best case and worst case for DeFi in terms of, does it end up making products that are too complicated and then no one ever trades them versus someone figures out a UX that, a traditional trader at Jane Street can use without having to know what gas cost is? And maybe this is to everyone, just kind of what do you think it'll take to actually make structured products usable? Because I think it's quite a big hurdle.
What this is reminding me of is probably you guys saw this, but Vitalik Buterin had a blog entry recently talking about his experience betting on prediction markets. And I'm sure a lot of people saw this, but basically there was massive mispricing on Trump contracts on one of these prediction markets. I think it was Augur, and the sequence of things he had to do in order to sort of capitalize on that seems incredibly complex. And this is one of the inventors of the whole system, right? So I think that sort of points to some of the challenges. I mean, I think something like owning a stock is sort of very easy to understand. But if you own a DAI, what is that really, right? How could that go wrong in extreme scenarios of the world? I don't know, right? So you have to. It seems to me that there's multiple points you have to sort of suspend disbelief in order to sort of get to something that you can comprehend. But I say this admitting that I'm generally ignorant in this, what's sort of state of the art in this space. So I'm curious what you guys think.
I think it's getting a little bit easier, right? The thing that's missing is ways to actually transfer risk between various participants, right? In that there's really not much in the insurance space. I guess there's Nexus Mutual as an insurance protocol, but it works in a very particular way. So there really doesn't exist that doesn't exist, or traditional, principal protected structures don't exist. So structured products, actually, in some the very simple ones at least, you think about how different people transfer risk between each other. Where you immediately went to puts as a DeFi industry, and that's actually like the most complicated one because you have all this like convexity and like all these complicated things like beta in there that are just harder to deal with. But like, there's no way to do just a principal protected node or something. Just hold your BTC and gain some like stable yield on it, and if some smart contract hack happens, somebody else eats that cost before you lose your principal or something like that. So those types of things don't exist in DeFi that maybe traditional investors would be a little bit more familiar with. I mean, I would push back on this idea that like the complexity is itself a problem insofar as that you can abstract from complexity. I mean, I think, for me, some DeFi things look way less complex than like some securitization structures that, I've been presented with by complete accident. There's immense amounts of complexity in the traditional financial system. I'm not necessarily sure it's less complex than DeFi, just maybe more, the types of risks are more familiar. And very often people are able to package those risks and transfer those risks more easily. And that just doesn't exist in DeFi yet. That's just my opinion.
Mm-hmm. Yeah, I mean, the only thing I have to add to that is kind of the problem with managing risk in DeFi, at least for me, is that like, and this happened, I mean, maybe I was just, it was the time that I actually went into DeFi, and it's like early 2020s when like, all of these crazy things were happening where people had weird, errors in their code that would cause them to like divide by some stupid quantity and drain them. So I don't know, the risk of catastrophic failure in DeFi does somehow seem higher, right? Like the tail ends of these events seem much higher, and there doesn't seem to be a way of obviously insuring against it. I mean, maybe formal verification or maybe some of these things, but in some sense, it's like kind of things that don't really happen in traditional finance, other than like, what I would call pretty complicated mechanisms.
Well, when they do, you go to legal recourse, right?
Exactly, right. But my point is like, in some sense, there's a human, and this is always a stupid argument that people leverage against, just like whatever blockchain. And it's like the classic, like, people who don't understand blockchain are like, wait, you mean you can't get your money back if someone scams you, kind of like stupid thing. But at a certain point, right, like it's weirdly not incorrect, right? Like, here's shit that happens all the time. It's like, oh, someone found a bug in a contract and just drained $6.8 million, right? Just by virtue of like having some silly, like incorrect thing being coded. And so it's not clear to me kind of what instruments are going to pop up around that to prevent things like this from happening, right? Or like, silly weird forks and things like that. I don't know. So I guess
I'm trying to think of what the analogous thing is in the traditional world. I mean, you have things like rogue traders who
right.
exceed their mandates and sort of blow up stuff. Maybe that's a similar, but it's kind of it's not a market risk. It's kind of like an operational risk, right?
Yeah, exactly. It's not a structural risk, I guess is what I mean, right? Like DeFi has in some sense like a really deep structural risk that's like really a tail risk that seems to be like intrinsic to the problem. But I don't know, in some sense, right? Like traditional finance kind of has analogous but not quite equivalent things, and it's not clear to me. It's not clear to me how one would mitigate this in DeFi, So, anyways, that's that I guess for fear of rambling on, I guess that's my one problem with DeFi that I still kind of have a problem with, and it's not obvious to me what the solution is, like even close. I don't know if Tarun has other thoughts on this.
Yeah, I mean, I think there are a lot of people who are trying to build these things. I think the problem is kind of like the problem I saw when I first kind of started getting into the space professionally, which was like, there's just a lot of people who hack together something and they kind of like are like, yeah, this must be the way it works. And then it either gets drained or it has an economic problem or whatever. And it's mainly because it's like 19-year-olds trying to make mortgage-backed securities, right? So like if we start with that premise, that it's like a very idealistic 19-year-old who like doesn't know what, doesn't kind of like know much probability, but it's just kind of like, well, I can write this in code, so I'm just going to do it. That works really well for certain things, right? Like Uniswap is an amazing fluke of nature in that it just worked the first time, and it turned out to be turned out to be like all of these things put together correctly. But these credit products and risk products are very much the opposite of that, especially when you have no recourse. And we've seen tons of hacks. I think the original Saffron Finance hack, all of the cover hacks. I mean, there's been so many related to cover, so it's kind of like a never-ending source of examples. And I hope that in like a cybersecurity class in the future, like people are just constantly analyzing these kind of insurance attacks, because they show that there's this much, much more complicated attack surface, and you kind of can't YOLO it the way that DeFi was able to bootstrap off the ground. But I do think that there is a sense in which, you know, in the same way that the computational constraints of Ethereum kind of led to Uniswap and automated and CFMMs, constant function market makers, really becoming the dominant form of exchange. I think there's probably a mechanism, a no recourse mechanism that does actually do things that are risk aware. And I think we're starting to see, especially as we see a lot of failures in projects that did fair launches that claim to do risk products, but they don't seem to be launching, or they don't do what they claimed. We're starting to see that, like, hey, actually, you do need to actually have these theoretical frameworks before you can actually build these systems. And I think the first thing that opened my eyes to it was Alex's paper that showed that you could replicate any unlevered derivative with a constant function market maker, which kind of says that you have to take advantage of the design space correctly to try to do this type of stuff. And we just haven't seen any teams that are kind of competent at that show up yet. But, you know, I think in the amount of capital that's entered the space kind of naturally means that talent will kind of flow in. At least that's the way I would view it.
By the way,
since we have a smaller...
any person in the audience trying to replicate any unlevered payout with a constant function market maker,
exactly,
would be dragons, as Guillermo sometimes says. You know, even there, to Tarun's point, which I think is a perfect point. In order to do that sort of stuff, you need to know exactly what you're doing. Because if you don't, you know, small things can really, especially if you have, you know, crazy payouts, you know, with high amounts of convexity and so forth, like small mistakes in the way that you configure your oracle to update your curve or something can really destroy you and the people that, you know, contribute capital to it. So these are very, very hard things to do, and you need not just technical talent to get it done, as you actually do need to understand the underlying payouts and functions that you're dealing with in order to understand what could go wrong and how to mitigate risk. And so risk awareness is just something that doesn't exist kind of as a, you know, DeFi people call it primitive, so maybe I'll use that term. It doesn't exist as a primitive yet. And as such, these things have been like very difficult to implement in practice.
But sweet, we're actually kind of reaching the end of the hour, and it's time for questions and kind of, you know, definitely thanks to Ciamac for walking us through his thoughts. But yeah, anyone who has questions, feel free to raise your hand and get up on stage.
Nope, we got one.
Yeah, I just have kind of maybe a basic or a dumb question, but so I think someone said that, you know, the way that the traditional financial markets handle tail risks is largely through lawyers coming in and you know, doing a bunch of stuff in bankruptcy and so on. And I wonder if you guys think that because of the nature of the space here, lawyers are going to have a much less significant or kind of, you know, ancillary role when tail risks are managed even by DeFi in its kind of evolved state, or, you know, what sort of role you think that those sorts of traditional tail risk managers are going to have.
So on your first question, as far as whether we're going to need fewer lawyers, I think just having spent a little bit of time on the venture side and work with teams that, you know, hire counsel and so forth, it seems to be that we need more lawyers, somewhat surprisingly. that, there's just, because of the complexity and the new types of things that you end up dealing with, the understanding, having somebody with, kind of a legal mind that can guide, teams, people building things through, the landmines that occur, in that web of contracts.
Right.
Is really important. So we've seen more of these. The thing that's kind of tricky, right, is that like you end up with a space of people that are technologists, and and they actually sometimes butt heads with lawyers, and that like technologists, the way of thinking of a lot of these 19-year-old building structure products that Tarun, I think alluded to are people that are confronted with something new, and they immediately say, okay, well, what's new and different about it? A lawyer actually looks at something new and is like, well, what's actually like not new about it, right? And so just like they're very complementary ways of thinking. And so a lot of people, have, very strong opinions about lawyers. But it is the case that the type of thinking is actually very complementary to the types of teams that are building in the space. So that's just a comment on your first question, but I already forgot your second question, and I'll apologize.
Well, so I guess, so that makes a lot of sense to me. And I guess, but a slightly more specific question I have is that, like, in traditional finance, you can try to kind of contract around any possible tail risk eventualities ex ante, but you always fail. And so there's always a role for bankruptcy and other kinds of procedures that come in. And then kind of, part of the role there is to just deal with tail risk style situations that your lawyers were not able to adequately make provision for beforehand. And I guess I'm just wondering, given the nature of the space here and the fact that so much of the stuff is, automated and so on, whether that traditional lawyerly role of like mopping up things that haven't been adequately provided for ex ante is going to be very circumscribed as compared to, traditionally in traditional financial markets. So, imagine that DeFi really develops and there's like a Lehman Brothers style situation or something like that, where just everyone is getting screwed. And I guess the question is, do you think kind of technical guardrails will have been put in that are going to relatively circumscribe the role of lawyers, or instead lawyers are going to be just as kind of important in those sorts of end games when DeFi is in a more mature state?
Yeah, to the extent that it's possible to revert certain transactions and so forth, if the protocols have ways of doing that, that's kind of a little bit antithetical to the current ethos of the space, for sure. So at the end of the day, the judge, jury, and executioner is like, where are the funds? And it's like, well, they're in some random wallet. It's like, well, all right, good luck suing a random hex address and figuring out who owns that because a hacker just drained it. And that's like the DeFi Lehman Brothers. There's no person that sold anyone anything. Somebody just like, Guillermo earlier said, somebody divided by a weird number on a contract, and somebody figured that out and just took all the money and left. So that's going to be a little bit tricky. We do see some things that are just like transposing, recourse like structures, like the Claros and the Aragon Court and so forth. We haven't really seen those like adopted in a big way yet. I think maybe there's some more native mechanisms of recourse and different types of tail risk mechanisms. I mean, just to be clear, by the way, all the different DeFi protocols have insurance funds. I mean, most of the major ones, I should say, rather, have insurance funds, their own to insure their user base. And then there's insurance protocols that insure the individual pools. And then, so there's a lot of different native insurance mechanisms, exactly because users have this kind of fear, and exactly because there doesn't exist this like recourse mechanism of like, Lehman or whoever the plaintiffs are, with Lehman as the defendant, being able to like, go after. I mean, to be clear, by the way, these things in the traditional world took a very long time to settle. I think a lot of the cases between like the federal home loan banks and the various people that sold the mortgage-backed securities, like maybe are still ongoing, or at least have been settled only in the last few years, right? Those types of things are very, very difficult to do on chain. Is like, can you do after you deliberate, on what you should do about this incident? Are you going to go back and do a 10-year reorg of the chain? At least on chain, those mechanisms seem very, very incompatible for now. So the question is like, how do we adapt legal practices, and how do we adapt contracts in order to deal with those potential eventualities, because they do seem probable in any kind of financial system.
Okay, cool. Thanks.
That was a fantastic question, by the way.
Oh, well, thank you. It was a great answer. Thanks.
Yeah, and one thing I guess what I would say is maybe from the perspective of like chargeback is that basically I don't think you're going to have this reversion aspect ever be culturally or socially accepted by cryptocurrency people. Instead, you're just going to have insurance mechanisms. And that's why we're starting to see so many of them kind of start to come out for a variety of different types of protocols. But it's still very premature. Like, I think the Cover hacks, Cover in particular, not to pick on them, but as a protocol, they've had just an inordinate number of hacks that have to do with the fact that they kind of are hoping that the market can correctly price these CDSs that they've developed. And instead, it's made the protocol an extreme honeypot for people to kind of try to attack. And so I think we replace recourse with insurance, and we replace it with insurance that clears as fast as possible, unlike in the normal world where the insurance might take a decade to clear, as Alex was saying.
Are there any other questions from anyone else? Feel free to raise your hand.
And if not, if we don't get anything in the next few minutes, definitely want to say thanks again to Ciamac for joining us. It was really great, and I think you might see some new research from all of us coming out at some point. But yeah, otherwise, thanks again, and I think it's always great to see kind of smart people from trading starting to realize DeFi is a thing.
Yeah,
Thanks for having me.
So
It was a lot of fun.
Yeah, definitely. Awesome. Thanks.
Thank you so much.
Cool. Thank you so
everyone,
much.
for joining.
Thank you for joining.